stop potentially a big deleveraging. And after a period of pain, generally speaking, policymakers jump in and they say this is becoming too untenable. So we're going to basically rotate debt onto the public ledger. So you have a big private sector, partial debt deleveraging, especially relative to GDP. You shift over more to the public ledger. You build it up there. Last time we went through this in the United States was the 1940s and much of the rest of the developed world. And then from there, it really has nowhere to go other than to be burned off through inflation.
The recent increase in Bitcoin represents a financial revolution in progress, not just another rally. Bitcoin is only getting started, are trading at about $115,000. The true possibilities are yet to come. Approximately $100 trillion in assets are managed by international organizations. There would be a $1 trillion increase in demand if only 1% of that went toward Bitcoin. It dwarfs today's $153 billion in Bitcoin ETFs, reaching $5 trillion at 5%. That is the launchpad, not a limit. It's not just investors either. Approximately $8 trillion in cash issued by corporations worldwide. Even a 10% investment in Bitcoin would add $1 trillion to the market when inflation devalues it. The focus now is on boardrooms and CFOs making calculated decisions, not retail FOMO. According to Lyn Alden, the view of Bitcoin has changed from that of magic internet money to that of a scarce, liquid, uncorrelated asset that is stronger than currency, harder than gold, and permanently limited to 21 million coins. Massive demand and complete scarcity combine to create a financial explosion that has the potential to redefine wealth itself, not just a bull run. The final rally, only the warm-up, this one, the primary event. Soon, people will ask, how did I miss it? Rather than why did Bitcoin explode? For more in-depth information, watch the entire interview with Lyn Alden. Also remember to like, share, and subscribe for more updates on the Bitcoin revolution as it develops.
If you're an emerging market country that tries this, you have debt often denominated in a currency you can't print, like the dollar, and so you're more likely to default nominally, much like a corporation or a household might. But if the debt's denominated in a country's own currency, then their default takes a different form, which is they still pay out every dollar or currency unit that is owed, but those are printed and those have much lower purchasing power than they had back in the years prior when those contracts, those bonds were made, when those bonds were issued. And so I think we're in that cycle now, which is they've already shifted a lot of debt to the public ledger. This is all built up for decades. And now they're basically in their default cycle, which for a developed country looks like the combination of debasement and financial repression. So yields often do not keep up with the growth supply of money. And anyone who is either forced or voluntarily holds the currency in the bonds generally pays the price. And those that are shorting the currency where they can, basically taking out debt that's low interest and long term, like people who locked in mortgages years ago, they're generally getting their liabilities burned away while they have instead owned harder assets that generally appreciate in price while this debasement happens. And this can happen rapidly. You can have like a 5-year period where things reset pretty rapidly. In the current environment, because we don't have, fortunately, some massive war. There are of course conflicts, but it's not that type of kind of 1940s environment, at least current time. Cross our fingers. Instead, it's a lot of it's based on structural demographics, entitlement systems that were designed in a different era with different demographics that always assume the next generation is going to be bigger than the prior generation. Now we have more aged and top-heavy systems. In the U.S., we have very bloated healthcare expenses. And we are entering a potentially more dangerous world. The last 30 years were defined by kind of globalization, Eastern labor and capital at least labor and resources coming to the market, Western capital coming to the market, these things combining into pretty efficient global supply chains. But that's also, there's been losers of that system. And now there's more animosity between countries. And so there's more frictions involved now. And so all these things kind of come together. The U.S. is basically locked into this period of high deficit spending, which is sort of a type of kind of background stimulus at the cost of debasement. And so things tend to run hot. So that generally means better stock market performance than you might otherwise expect, better performance of hard assets like gold and Bitcoin. The real laggard so far is energy because there's really been no major supply bottlenecks there. And so energy's still pretty cheap, which helps keep official levels of inflation down. Um, but I think longer term, this whole trend is going to continue with 6 to 7% of GDP deficits in the U.S. basically as far as the eye can see, and then a handful of European nations in kind of a similar role for the most part in a lot of developed countries. Um, and I think we're in a slower motion one. So again, because it's more of an entitlement crisis, a demographics crisis, and a political polarization crisis, more so than a major war. Instead of everything kind of happening in a 5 year stretch, I think it happens over a 10, 15 year stretch. So my general view is that we head into the 2030s. So we've already been in fiscal dominance for years now. I think this probably continues for the rest of the 2020s, and probably into like the mid 2030s, of just things running hot and currency and bonds continuing to underperform other assets. Now, what happens from there? I'd have to reassess to get closer to that point. Basically, there are certain decision points along the way that can change my probabilities. But if a country kind of gets heavily polarized, populist, and rips itself apart, that's when you get some of the more extreme scenarios like massive.
Investors typically balance their portfolios among equities, bonds, real estate, and even cryptocurrencies based on long-term expectations for capital market performance. Without accurate data regarding potential future returns, investing becomes an exercise in speculation. In response, Bitwise developed a data-driven forecast for Bitcoin's future role, particularly as institutional interest in the cryptocurrency expands amid rising global debt, continuous money printing, and increasing currency instability. Bitcoin's attraction lies in its function as a digital store of wealth independent of banks or government control. It operates as a global system powered solely by user demand rather than corporate or political influence. Ownership of Bitcoin grants individuals the right to participate directly in this decentralized network. As worldwide debt escalates and trust in traditional currencies erodes, Bitcoin's popularity continues to grow among investors seeking financial security. This changing landscape has been largely shaped by two pivotal developments: the introduction of quantitative easing after the 2008 financial crisis and recent geopolitical events revealing that even central banks may lose access to traditional reserves. Although gold has long served as the traditional medium for preserving wealth, Bitcoin represents a more modern alternative thanks to its portability, transparency, and divisibility. It is conceivable that, in the future, central banks could hold Bitcoin as a reserve asset akin to gold. As Lyn Alden emphasizes, for deeper insight into this evolving narrative, we should revisit the interview.
Currency loss, 90% devaluations, the type of things you see in emerging markets or countries that have lost wars, basically, or you can, pivot, do a lot of policies that start making sense, stop the bleeding, and kind of, what is at that point, there's basically been a default. Currency's been cut in half or cut in 2/3, but then they managed to stabilize. Those who saw this coming and were kind of positioned throughout it are in better shape. One of the other things to watch out during this whole time is you tend to get increased nationalism. We saw this in the 40s, and actually we're seeing it again now, which is basically more kind of top-down issuance of how things ought to be, potentially interfering with businesses, potentially increase capital controls and things like that. So that complicates the investing landscape because you could, in theory, on paper have all the right moves you want to make for this currency devaluation, but then the government can come in and say, well, your 401k has to own some bonds, or all pensions above this size have to own some bonds, or we're going to start telling equities companies that they have to do X, Y, and Z. And these kind of more outlier draconian things tend to become more likely when the sovereign itself is kind of flailing in its inability to stop the blood loss. They don't just kind of let it passively happen. They try where they can, at least, to shift the burden on other places. Now, compared to the 1930s and 40s in the U.S., we have a more polarized environment now, which is to say that, for example, back then, the president also had like 70% of Congress, basically a supermajority. That was a very unified environment. Culturally, we had kind of this mentality of like all in it together. Not us, but like our grandparents. And so That was a different environment back then. So now it's a messier environment. They don't necessarily have the same level of draconian things that they can just do. Also, media flows faster now, so people can meme about the government rather than read it in the newspaper like a week later. So it does change the landscape, but that is a very complicating variable to what otherwise is basically a straightforward thing. Short currency, own our hard assets. That's straightforward enough on paper. And just that added complications, you also have to dodge financial repression, capital controls, and kind of targeted strikes at some of the assets you might otherwise be liking to own. Full steam ahead. The whole Doge thing was pretty minor. I mean, you can't really even point to Doge on like a
Yeah.
physical chart. There's obviously
Good
certain
intentions.
certain yeah, certain programs were targeted, but they didn't really have the authority to go after the biggest things. So that was kind of not a big thing. The one that so far I think can slow it down potentially is the tariffs. And the reason for that is that most of the other levers like taxes and spending cuts go through a very polarized Congress where these things are unpopular. Tax increases are unpopular. Anyone who's targeted them will try to lobby against them. Also, spending cuts are very unpopular. So, especially the voting demographic that votes, people that receive Social Security, Medicare, things like that. These are very unpopular to cut. Defense spending is very unpopular to cut because many Congress people have certain parts in their district that are receiving that government spending, and they don't want to have that cut because their employees are voters in their